Hey everyone, hope you're enjoying your Sunday afternoon. Just wanted to post this video about a scenario I had with one of my pre-approved buyers yesterday. This person, just to give a little background, had low credit. They were looking at single family homes and had a max monthly budget of $2,500 to include the property taxes, homeowners insurance, and the mortgage insurance because they didn't have 20% to put down. So usually in that case, I would take that person FHA because with the lower credit scores, you're probably with FHA get a lower interest rate and lower mortgage insurance than you would on a conventional loan, which is heavily based on the credit score. But for them, unfortunately, they had a very specific reason with their file that they are disqualified from going FHA across the board. So with that said, when I did their quote 2 weeks ago, their max purchase price to stay within that $2,500 monthly budget was $350, and they called me yesterday, really excited because they found a property that was at $330. However, that property was a townhome, and it came with $315 a month in HOA dues. So, and above and beyond that, the property taxes were a little bit higher than what we normally would estimate. Now, as some of you know, over the last week, interest rates have definitely gone up some. So factoring all those things in, the normal mortgage lender would have just plugged that information in the file under the current structure and said, hey, listen, this total payment's going to be $2,800 a month. It's over your budget. You need to keep looking. So instead, I decided to get creative and think outside of the box a little bit. And a couple of things to go over first. One, all of my buyers right now, we're putting a strategic plan in place to circle back for a refinance to drop the interest rate in the next 2 to 3 years, because that's when most experts predict that the rates will drop again. So we already know that much for everybody that's buying right now. So another thing to understand is that right now, rates on adjustable mortgages are significantly lower than what they are on the fixed mortgages. And that hasn't always been the case, especially recently in our industry, because the rates had just gotten so low on the fixed mortgages, especially back in 2020. But right now, there is a significant difference between those programs. So I've switched the loan over to a 5-year ARM, which is perfect because if we know we're going to refi in 2 to 3 years, then that means the rate will be fixed for the first 5 years, so we don't have a problem there. And there's no prepayment penalty either, so nothing going to hinder the refinance that's coming up. And by doing that and dropping the rate significantly, I did bring the payment down, but it was still at $2,700 a month. And obviously that's still over her max budget of $2,500. So at that point, what's the other option you have to carve out of the payment? And if you guess the mortgage insurance, then you'd be 100% correct. So what a lot of people don't know is that there are other options instead of paying the mortgage insurance as a part of your monthly payment. The first option is to get lender paid mortgage insurance, where the lender picks up the tab on the mortgage insurance, but you do get a significantly higher interest rate. And in this market right now, that's definitely not a good option to do, especially if we're having challenges with monthly budget in the first place. The second option is to buy out the mortgage insurance with one big lump sum premium that gets added into the closing costs. But the challenge with that is if your buyer is in need of mortgage insurance in the first place, then obviously that means they don't have 20% to bring to closing. So they may not have an extra $8,000 to bring to closing to buy out the mortgage insurance, which that was the amount of what it would be in this particular case. So the only other option that a lot of people are unaware of is that you can finance that single premium into the loan. And so by switching her to the 5-year ARM and financing the mortgage insurance, her payment with everything included with the HOA was right at $2,500 a month. And it didn't change her estimated cash to close from what we already had. Now, a couple other things to consider with that is one, the break-even point, meaning if she took the monthly mortgage insurance amount after 40 months of payments, which is just over 3 years, she would have paid that $8,000 anyway. So it's not like it really, affected her in the long run to take that single premium on. The second piece is that a portion of that is tax deductible as well. So these are just things that, when you hear about, does your mortgage lender add value? I think this is the type of stuff that we're talking about, right? If your mortgage lender you're working with right now is not getting creative, thinking outside of the box, educating the client and educating you as well, you're pretty much assured to be losing business and opportunities that you could be out there helping people. So I hope this was informative, and I hope you guys enjoy the rest of your weekend. Thanks.